On today's show, how business planning strategies benefit third-party funding. Part 3 of this week's series on self-funding index universal life for income with premium funding strategist and attorney Robert Strauss. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Robert.
Thank you, Steve.
I tell you what, you're kind of blowing my mind, all these applications. I thought I had this thing down with different forms of income, but you're really bringing us to a whole new boilerplate. And today and tomorrow, we're going to be doing case studies. We're going to show the corporate, which is going to be today. What about corporate funding for this? Tomorrow we'll deal with interfamily, and then we'll also deal with asset. So today I want to give you just a small list and potpourri of what we can do. Now, when you say leveraged pension rescue, now that caught my eye, because when I think of pension, traditional pension rescue, sure, I know what that means.
Yep.
What do you mean by I'm rescuing a pension?
Well, to me, it means moving a life insurance policy from a profit sharing plan out at a discount of some sort. And this provides kind of a twist on that, a way to do that and leverage that as well.
So I have, let's say I have a contract inside a profit sharing plan, and I need to get that out of there. I mean, sooner or later, that death benefit's going to be, it's going to be part of that whole equation.
Correct.
How am I getting that out of there?
Well, this allows you to actually use the asset-based private SFI to use the funds that are already in there, in the profit sharing plan, to fund. Basically, the funding source becomes the assets that are already in the profit sharing plan, and to, at the end of the 10th year, reimburse the profit sharing plan, and then take your distribution or sell the profit sharing plan at the end of the 10th year. But now the cash surrender value in the plan is going to be a lot less, so the perk value is going to be less as well. So
if I have a contract, if I'm hearing you right, advisors should be looking for life insurance inside qualified plans that need to be rescued before termination or death, because it could be a big issue tax-wise. Right. What about endowment max plan? What is that all about? Maximization plan.
Again, another similar example to what I just described to you. It's another way to use funds that have already been gifted to a charity. Just imagine charity is sitting on assets that have already been gifted to them, and they want to make those assets work harder. They can use those assets, max fund the premiums into a policy at the end of the 10th year, take those dollars back by borrowing from the policy, creating arbitrage within the policy. Now, the insured would probably be some kind of a donor, or probably a very close donor who sits on the board. But again, every 10 years, it recovers those assets, and it can create an income stream for itself. It can have a death benefit for itself, and every 10 years, it recovers the same dollars, and it may end up insuring the new board members every 10 years.
Wow, I have never heard about that. I love the cycle, because usually nonprofits are perpetual, and this is a great way to just keep refunding every decade. We're bringing new monies in. Wow, that's
very clean.
We're going to have to look at that as a separate workshop. Leverage multi-generational plan. I love stuff like this, because I think we're going to see, I'm already a grandfather, I think I'm going to see great-grandchildren. Multiple generational plans. Wow.
Exactly. Same idea. We're going to talk about this. I'll give you an example in a second. But mom, dad, grandma, grandpa, whoever wants to pass wealth on, but instead of just making a gift and paying gift taxes, they're going to lend premium dollars and create that leverage. And in return, the insured, usually often adult children, are going to pay interest for 10 years and eventually pay back the loan using a policy loan. And
now, every time we start using phrases like zero net outlay, I get pretty excited. You got 5 big ones here. Retirement plan, we know about that because we're leveraging interest versus premium.
Yep.
Okay. But now estate plan, the same thing. Why should I pay premiums for estate or state domicile planning, right?
Correct.
Doing the same thing there. And now this is the one I really like, because a lot of people say, man, I don't want to do the buy-sell, Steve. I know I should do it, but I hate funding life insurance. I'm just going to buy the term and be done with it. But they never really do half of what we tell them to do. But here's an idea where I can walk in and leverage assets of the corporation, which I love, and do a buy-sell, cross-purchase, maybe a stock redemption, maybe even a wait-and-see trust, depending upon how it's set up. This is a huge idea for business.
Exactly.
And again, I think we're going to do seminars on each one of these.
We might have to.
And then key man, another corporate idea here. I have an exec, a big rainmaker. I want to make sure I bless this guy, but I don't have the funds, or I want to leverage my assets. That could be a huge issue to make my key person really feel, because I want to, the headhunters out there are out there. They're always looking for our guys. This could be a great way to give an executive bonus plan without me shelling out real big money.
Exactly. A way for them to pay for these things and fund these things just for the time value of money, basically.
Now, this next one, and this is where we're going to go in our case on our second segment, we're going to talk about the net outlay and a deferred comp. We're going to use a physician, an idea on this.
Sure.
This is where I think you can hit the professional market, you know, attorneys. I think that's a big one. You're looking at physicians. There might be some play here in bigger areas. Trust officers know all these people that they're managing trusts for. This could be a huge play for them as well. We come back from the break, we're going to zero in on this one case idea using a kind of a leveraged retirement plan right after the commercial. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, I'm with attorney Robert Strauss, major funding strategist. I love these strategies. We're looking at the corporate private SFI. This is the really cool one. Yep. Dr. Thomas, age 36. He's a partner in a small, by the way, this is a big part of this, a small cardiology practice, earning $500,000 with a net worth of $1.5 million because he's at the front end of his career. And yes, competing medical corporations are trying to buy doctors and raid these small firms all day long. As well as the cardio group needs a low-cost retention tool. By the way, we always forget about the back end. We understand this as a recruiting tool, but we don't see it all the time as a retention tool. Now, let's walk through this because this to me is numbers with glamour. I'm sorry to say, this is really glamorous. Walk me through this. And by the way, this is your patent. This is your spreadsheet that you've developed.
Yep. Keep in mind, as part of the facts here, that he doesn't qualify for premium financing. His net worth is too low. His income is fine, but his net worth is too low. So even if they wanted to go out and borrow from a bank to do this, he would not qualify. Fortunately, in this case, the medical group has the cash flow, or maybe they just have a line of credit where they can tap into, and they're willing to fund the premiums for him to make sure that he stays on. They probably have some kind of a side agreement with him as well, so if he leaves early, he's got to pay back the loan early, and that's not going to be easy for him to do because he'd have to surrender the policy, and he's got surrender charges. So,
by the way, that was a huge point. So I just protected the issue of vesting because of this very thing. But that's another thing we should talk about.
Very, very important.
Yeah, wow.
The premiums here are $100,000 a year for 7 years that the medical group is going to be paying. But keep in mind that as soon as they pay the $100,000, he's going to pay them $14,000 at the beginning of the year. This is interest that is due at the beginning of the year with some principal mixed into the interest. That's our amortization schedule here of $14,000 per year. The interest rate that we're assuming is 3%, which is greater than the AFR rate of 2.67% long-term currently.
Now, I noticed here in your green, you could have, this is his income, right? So he's willing to pay the interest back, right?
Correct.
Okay, because he's going to get a huge, we're going to see this in a second. Now, did you put, this is just standard loans. I know sometimes you use COLA on some of this. Is that shown in our next slide?
Believe it or not, this has COLA built into it.
Okay, so it's already built in it.
It's just that because there's such a long period of time, he's so young, it's already, the COLA has already reached its maximum plateau. Now,
I want you to walk me through this last one. We're using 6.9% with a 5% fixed loan rate. What is that last column on internal rate of return? Is it the actual on the life insurance, cash on cash, or is that the death benefit?
It's both. So whenever you look at the internal rate of return column here, it's the rate of return on his outlay based on income and death benefit at the time that you're...
At any one time.
At any one time.
That is, I don't know how many spreadsheets have done that, but I'm wondering how many have homogenized those two into one IRR.
Well, I always do because I'm assuming that he's never going to surrender because, again, you never want to surrender this.
Okay, here we are again on this second one.
Okay, so at the end, now keep in mind that he may pay the interest himself each year, or they may take that out of his salary as a salary reduction, or they may bonus that interest to him, or double bonus that interest to him. There's a lot of different ways that they can structure this. But either way, that's going to be his cost, the employee's cost. And at the end of the 10th year, then his policy is going to, he's going to take a $700,000 policy loan to pay back the loan, as you can see over there in column 3. So at that point in time, the medical group has now really been being completely paid back with interest.
So they're done. He owns this policy.
They're done. He owns the policy. He's been there 10 years. Let's go to the next slide. And as you can see, at age 65, he begins receiving his benefit here of $227,000 a year. Now, these are policy loans, and as long as he doesn't surrender or let the policy lapse, then these are all tax-free. And in addition, at age 90, we've got almost a $2 million death benefit. If you look at the internal rate of return after taxes, it's about 12%. As you pointed out, that's income plus death benefit.
Just a little curiosity, and you may not know this, but what percentage of that almost 12% return at that time is the death benefit versus the cash? Do you have any idea?
I don't know exactly what the breakdown is. I have calculated this without the death benefit, and it's still quite high. So
we might
think
be maybe
it's probably
9.
9 or 10.
Okay,
yeah.
wow. So it's really a small piece of the bigger IRR.
Yeah, in the earlier years, it's obviously a bigger piece.
Right.
But by then, it's a smaller piece.
Okay.
Okay. If we do our comparison to what he could have done with this money, for example, let's say we gross up the contributions and he had put $23,000 a year into a qualified plan, which is probably what he would have done with that money. You can see that had he tried to match the income stream, he would have run out of money in just 3 or 4 years. So it's very, very difficult for a qualified plan or really any kind of retirement vehicle to compete with the income stream that we're able to generate here at just a 6.9% crediting rate.
This is a huge example of using corporate dollars for a key employee. This is just one of the many examples. And again, remember, no bank is involved in this idea.
No bank at all. So we don't have to go outside. He's got a death benefit that he wasn't going to get. He doesn't have to go out and buy a separate policy, which would have been an additional expense to him. He's got inflation built into here. So if it turns out that interest rates go up, let's say inflation went from 3% to 5%, his income would go from about $227,000 to over $300,000.
And again, we're comparing different assets and different taxable assets to try to give a fair guesstimation. Could I went someplace else for this? Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.